This is Ralph Sass, and this is Accounting 212, the lecture to Chapter 1. This is a continuation of what we were doing in the last video, and we left off with analyzing mixed costs. There are two types of income statements, okay? For external reporting purposes, you must use what they have here called the traditional, okay? Format, and this is the type of an income statement that we looked at last semester. It has to be used for external reporting, and what you would have is you'd have sales subtracting your cost of goods sold. That would give you something called your gross margin. If you see gross margin, you know you're using a traditional format income statement. Then you subtract your selling, general, and administrative expenses, and you get your net income. Under a contribution margin format, what you're going to take is you're going to take your sales, and then you're going to subtract all of your variable expenses, whether those variable expenses are product expenses and or selling and administrative expenses. So what you do is you move all the variable costs up here, and that will give you something called the contribution margin. And the idea behind the contribution margin is that is the amount of money that can contribute to covering your fixed costs. And so then what you do is that gives you your contribution margin. You then group all of your fixed costs, in this case 30 grand, and that gives you, in this case, 10 grand. This format is used a lot by management. Notice the net income in this case is the same. Okay, it should be for most purposes, unless you're producing things and throwing them into inventory and what have you. But we'll talk about that complication later. Okay, for the most part, they should be the same. And the reason why managers like contribution format is because it will start to tell them things like a break-even point. We're going to talk about that in one of the later chapters. But one of the beauties of the contribution format income statement is it allows us to calculate things like break even and things like that. Okay, so notice that contribution margin format is going to be used throughout the rest of the text, and so we're going to come back to it in a number of cases as the semester goes on. We talked in terms of fixed and variable. We talked in terms of direct materials, direct labor, and manufacturing overhead. Another definition or another term we can use is direct versus indirect costs. Direct costs can be directly traced. Indirect costs cannot be directly traced. Okay. Now there is an important distinction we need to make when we're making decisions. And not all costs are relevant for making decisions, so what we need to do is take a couple of minutes and take a look at what costs and what benefits, for that matter, should be ignored. When we have costs and revenues that differ among alternatives, when we have different costs, what we need to look at is the differential. When we're making a decision, what we need to look at is the differential. Now, many of you know this. Many of you live in rural communities that are a long distance from the major towns around here. Okay, you realize that they may pay you more money to work in that bigger town, but there's that offsetting part that you're going to end up paying more in gas. You're going to end up paying more in oil changes. You're going to end up taking more time on the road, and you weigh those costs and the benefits. The same thing applies for business. So when we're taking a look at differential cost and revenue, suppose in this case we have a job that's paying us $1,500 per month, and you have a job in a neighboring town, i.e. Roanoke, what have you, that'll pay you $2 grand, and your commuting cost is $500 or $300 a month. Notice, yes, you're going to make $500 more, but that is not the cost you need to, not the total that you need to incorporate. You also have to also incorporate that the commuting is going to cost you $300. So after all is said and done, you're only going to have $200 in this case of additional income. So it's going to raise your income, yes, but is it going to raise it? I'm going to argue substantially no. Why? Because it's only $200, not the full $500. We also have to weigh and consider opportunity costs. And an opportunity cost is what we give up when we make a decision. And for those of you that have had me in economics, we talk about this all the time. Okay. So notice in this particular case, if you were not attending college, you could be earning, probably more than 15 grand, one would hope. But you could be earning 15 grand. So your opportunity cost of going to college is 15 grand. So by sitting in class, you're giving up that 15 grand. Okay. And finally, there are sunk costs. Okay. And sunk costs are costs that have already been incurred, and no matter what we do, okay, these costs cannot be changed. And notice what it says, and for some of us it's really hard to do this, and I use examples in economics, so I'm not going to talk about them here, but those costs should be ignored when making decisions. We have to consider the opportunity costs. We have to consider some of the other costs. Sunk costs, however, should be ignored. Okay? So, we bought, in this case, an automobile for 10 grand 2 years ago. That 10 grand is a sunk cost. It's gone. There's nothing we can do to get it back. Okay? No matter what we do, if we drive it, we park it, we trade it, we sell it, we can't change the fact that 2 years ago we bought that truck or car, in this case automobile, for 10 grand. So there are, just kind of a brief quick summary here, there are a lot of different types of costs, okay, and the reason why we work on all these classifications, whatever, is because it allows us to make better decisions. A couple other items, and these are in the appendix, and it's not 2B, it's 1A, I believe, but this is in the appendix, and it's an important thing to realize, and that is incorrect, but it is the appendix on cost of quality. Could be I think it's chapter 1 where this is. It's got to be chapter 1, I think. Quality is an important item today, and any costs that we incur to prevent. It's going to skip ahead. Sorry about that. One of the costs we need to worry about is the costs to prevent defects. Okay, so one of the costs of quality is the quality of making sure that our product conforms to whatever the standards are or whatever the contract says. We can then also have prevention and appraisal costs. Prevention costs are those costs that we incur to prevent a failure or a defect, and appraisal costs are those costs incurred to identify defective products. I've got a buddy that owns a machine shop, and in that machine shop, every hour he takes a couple of items off of that production line and pays one employee, and their sole job is to take a couple of products off of each of the machines every hour to check to make sure that it meets specifications, so that if it doesn't meet specifications, they have time to stop the process and make whatever changes are necessary to ensure that they comply. By the way, if they fail to comply, if the person who they're selling it to finds one product that does not meet the standard, they get the entire shipment back, which could be a week's or even more of production, and it'll be their job to check it, and they'll have to pay for shipping. So it's in his best interest to check those items as they're coming off. And then finally, we can have internal and external failure costs. Internal failure costs are those costs that are incurred identifying the items before they're shipped, and external failure costs are after they've been shipped, things such as warranties, getting the product shipped back to the factory or the warehouse, and those types of things. So notice, and here's just some examples of all the various types of expenses that can fit into each of these items. Prevention costs, things like quality circles, statistical process, and checking things to make sure there are no errors. Appraisal costs, testing and inspecting incoming materials. Sometimes it's necessary to do that. Hopefully your supplier is checking it before he ships it, but sometimes they don't. Final product testing it before it goes out the door. Okay, keep in mind you have things like depreciation on your testing equipment. Okay, you may have interest expense on your testing equipment. Okay, you may have expenses like that. We can talk in terms of internal failure costs, things like scrap, spoilage, and having to rework it. And then we can talk in terms of external failure costs. Okay, cost of servicing, the field servicing, warranty repairs, lost sales. You get a bad reputation, and individuals don't buy your product anymore. The whole idea from this, and in the past it was much less of an issue, but today it's to the point where we virtually have to get 100%, and the reason is a lot of times if we can get 100%, that's going to be the lowest cost. Okay, notice what happens here. As we spend more on appraisal and prevention, notice what happens to our internal and external failure costs. And you find graphs like that are very common, and what it basically says is it pays to spend the money on prevention and appraisal in reducing internal and external failure costs. A lot of companies put together a report that looks something like this, and a couple of quick notes about what they've done here. Notice what they've done is they've taken the costs, prevention, appraisal, internal failure and external failure, listed all the costs. They calculated it as a percentage. Okay. And notice they calculated it as a percentage of sales. Okay, as a percentage of sales. Okay. And then they compared year 1 to year 2. Okay. And notice what happened in year 1. Total cost of quality was 18%. Okay. Now, putting together these numbers is much easier on a chart like this and in a classroom than it is in the real world. Okay. But notice what they did. They spent more money on prevention costs, both in gross dollar amounts and as a percentage. Okay. And they also spent more money on appraisal costs. Okay, things like inspections and what have you. Okay, now notice what happened in this case. They ended up spending more on internal failure costs, probably because they were finding all those items. Okay, but notice what happened to their external failure costs. It went down rather substantially, and overall the total cost of quality went down. Why? Because they spent more on prevention, appraisal, and internal failure. Now, a couple of quick notes. To the extent they spend even more perhaps up here, and to the extent they improve their process with a quality circle or whatever to find out where the errors and where things are going bad, one could theoretically perhaps even spend a little bit more on prevention, maybe even a little bit more on appraisal, and see these internal and external failure costs fall even more substantially. Okay. A lot of times they may also prepare it in graph forms. There are a number of us, and in fact there's some students here in class, I'm sure, that look at all these numbers and go blah, 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 blah. Okay. Yeah, just a lot of numbers, just a lot of percentages. And if you put it in a situation like this, okay, where you've got an internal and external in graphic forms, for those of us that don't like numbers, it becomes a lot easier. And you can see they spent a little bit more on prevention here, but a lot more on appraisal. And in this case, their internal and external failure costs went down. So sometimes it pays to turn those items into graphic format. What this does, what these reports do, is they help managers see the financial significance of those defects. Okay, helps identify the relative performance. Hey, where are the quality problems happening? And it can help to determine if those quality costs are poorly distributed. Are they all in one area, or are they spread throughout the firm, or what have you? Some problems, okay, and I'm going to point out the one probably big one right away. My data, the numbers I was using, results usually lag behind, i.e. if I put in a inspection program, is it going to be a reduction in internal and external failure costs immediately? And the answer is no. It may take a year, it may take 2 years for it to show up. Okay. Notice also that some things, such as lost sales, are omitted from quality reports. How much did we lose in sales by having poor quality products? It's really hard to tell. Okay. And notice, by simply reporting them doesn't do anything about it. We actually have to take action, find out where the errors are, what's going wrong, so that we can go ahead and fix the problem. That concludes the lecture for Chapter 1. Should you have any questions, please feel free to let me know.